With the Kenyan MPC having released its monetary policy rate this afternoon, we get a look at the numbers and the effect on the markets with Paul Mwai, the CEO of Afrika Investment Bank, joining us now live from Nairobi. Thank you so much, Paul, for joining us. As I mentioned a little earlier, of course, the rate decision out already, 18% unchanged. And the point is that inflation is starting to come down, at least sitting at around 18% from the previous number that was so close to that 20% level. Does this mean that the restrictive monetary policy scenario in Kenya is actually working?
I don't think it's working yet. I think the level of the drop in inflation is too small to say that the monetary policy effects have begun to work. I have a feeling that the Monetary Policy Committee is a bit disappointed with the level at which inflation is coming down. I think inflation still remains a threat, and I think in their statement they have mentioned the issue about going into a dry spell in the next few months, which means that food prices will continue to be on an upward trend. When we look at the inflation figures, the only item that went down during that month was transport, which was widely expected due to the falling fuel prices. But all other items tended to maintain their upward trend, which tends to suggest to me that we are not yet out of the woods in as far as inflation is concerned.
With regards to the inflation scenario, you alluded to it quite extensively. At this point, we know that food and fuel is coming down. It is those two big import items that we're seeing in Kenya. On a global level, we're starting to see a slight softness, perhaps not so much on the fuel part. At the end of the day, it's also affecting the growth and, of course, affecting consumers quite extensively. What kind of scenario are you playing out with regards to the GDP number that could be expected this year?
I think the impact of both inflation and rising interest rates will begin to be felt on GDP figures. We've seen the central bank MPC issue a statement, also in their statement mentioned that the level of credit growth has begun to slow down. That's going to have an impact on economic growth. The uncertainty that was created by the unstable macroeconomic environment will continue to play out for the better part of the first half of this year. I don't expect to see any good numbers coming out. I think we will continue to see growth of between 3 to 4% for the first half of this year.
With regard, I mean, also the food, we know that has been affected by the drought. It seems that we might just experience a bit of reprieve into this year. Is this your expectation as well, and are you feeling optimistic on this point?
I think it's too early to call that. I think we are in a dry spell right now. January, February, traditionally very dry months. The short rains begin towards the end of March to April, and so for the next 3 months we can expect pressure on food prices to continue, and I think the food price situation can only correct once we know a clear picture on how the long rains will look like.
With regards to the interest rate environment, 6.5% was sitting at not too long ago, and then now sitting at around 18%. It's had an impact on the private sector credit extension numbers as well, but we know that the banks are looking relatively stable. With regards to the investment case within the banking sector, is there a concern on your end that we'll still see subdued numbers coming through from the banking sector?
I think yes, but that will probably be not in the 2011 figures, which will be announced perhaps in the coming few months. I think the impact of that will probably be felt going forward. So I think in as far as the figures we are seeing now, that impact might not be too great. I think the bigger impact on banks will be because of bond pricing in terms of the annual figures. The impact in terms of the increase in loan defaults, I don't think we are going to see that immediately. That should come in perhaps later, should interest rates remain high at the current level. Having said that, we've seen a bit of reprieve on interest rates on the T-bill and the T-bond, so there is some signs that pressure on interest rates is easing to some extent. I think the foreign currency loan of $600 million, which the government is looking for, $600 million, which the government is looking for, means that their dependency on domestic credit is slowing, and that should help ease interest rates. And unfortunately, inflation doesn't support the Monetary Policy Committee perhaps responding in that way. I think they need to be completely sure that the beast of inflation is well and truly tamed before they can begin to lower interest rates.
Absolutely. Thank you so very much, Paul. Great to have you on the program. Paul Mwai, the CEO of Afrika Investment Bank.